Ever wondered how a private company suddenly appears on your stock trading app ready for you to invest in? That big moment is called an initial public offering, or IPO. It's like a company's grand debut on the public stage, switching from private ownership to being publicly traded. Today, we're going to demystify the entire IPO process from start to finish. We'll look at why companies do it, the steps involved, and what it means for investors like you. So, why does a company go public? The primary reason is to raise a huge amount of capital. Think of it as a massive fundraising event. This money can be used for expansion, paying off debt, research and development, or simply to give early investors and employees a way to cash out their shares. Becoming a public company also boosts its prestige and public profile. Suddenly, everyone's talking about it. But it's not a simple decision. Going public means a lot more regulatory scrutiny from bodies like the Securities and Exchange Commission, or SEC, and they have to disclose their financial details to everyone. No more secrets. The IPO journey is a long and complex one, often taking 6 months to a year or even longer. It all starts with the company choosing its team. The most important players here are the investment banks, also known as underwriters. Big names like Goldman Sachs or Morgan Stanley often lead these deals. Their job is to guide the company through the entire process, help with paperwork, and ultimately sell the shares to the public. The company and its underwriters work together to prepare a critical document called the S-1 registration statement. This is basically the company's biography and financial tell-all filed with the IT. It contains everything potential investors would want to know: the company's business model, financial history, potential risks, and how they plan to use the money raised. Once the S-1 is filed, the SEC reviews it. This can involve a lot of back and forth, with the SEC asking for more information or clarifications. This period is sometimes called the quiet period, where the company is limited in what it can say publicly to avoid hyping up the stock before it's approved. While this is happening, the real marketing push begins. This is the roadshow phase. The company's executives and the underwriters travel around, meeting with large institutional investors like pension funds, mutual funds, and hedge funds. They pitch the company, answer tough questions, and try to gauge interest. The goal is to build a book of orders from these big players, essentially getting commitments to buy shares at a certain price. This helps the underwriters figure out how much demand there is for the stock. Based on the demand from the roadshow, the company and its underwriters decide on the final IPO price and the number of shares to be sold. This is a critical moment. Price it too high, and the stock might fall on its first day of trading, which looks bad. Price it too low, and the company leaves money on the table. It's a delicate balancing act. On the night before the IPO, the price is set. The shares are allocated to the institutional investors who committed during the roadshow, and a certain portion is also set aside for retail investors, though it can be hard to get your hands on them. Then comes the big day, IPO day. The stock begins trading on an exchange like the New York Stock Exchange or the Nasdaq under its own unique ticker symbol. You'll often see pictures of the company's CEO ringing the opening bell. The opening price on the market isn't necessarily the IPO price. It's determined by the first buy and sell orders on the exchange. If there's a lot of excitement, we might see a pop where the stock price jumps significantly above the IPO price. This is great for those who got in at the IPO price, but it also means the company could have priced its shares higher. Let's look at a real-world example. Airbnb. When Airbnb went public in December 2020, it was one of the most anticipated IPOs of the year. They initially planned to price their shares between $44 and $50, but due to huge demand during their roadshow, they raised the IPO price to $68 per share. When the stock ticker ABNB started trading, it didn't open at 68. The first trade was at $146, more than double the IPO price. It was a massive success for the company and early investors. However, not all IPOs are like this. Some trade flat or even drop on their first day. This brings us to the risks and rewards for retail investors. The potential reward is getting in on the ground floor of the next big thing. If you had bought Amazon or Google shares at their IPOs and held on, you'd be very happy today. The hype around an IPO can lead to quick, substantial gains. But the risks are equally significant. IPOs are often very volatile. The company has a limited track record of being a public entity, and the initial hype can fade quickly, causing the stock price to fall. This is sometimes called the IPO curse. Many studies show that, on average, IPOs tend to underperform the broader market over the first few years. Companies often go public when market sentiment is high, which can lead to inflated valuations that aren't sustainable. So, how should you approach an IPO as a regular investor? The key is research. Don't just get caught up in the hype. First, read the S1 filing. Yes, it's long and dense, but it's the single best source of information. Look at the company's financials. Is it profitable? Is its revenue growing? What are the specific risks the company lists? Understanding the business model is crucial. Do you believe in what the company does and its long-term vision? Also, look at the valuation. Compare its price-to-sales ratio or other metrics to its publicly traded competitors to see if the IPO price seems reasonable. Finally, consider waiting. You don't have to buy on day one. Often, after the initial excitement wears off, the stock price might settle down or even dip, offering a better entry point. Let the dust settle for a few weeks or even a few months. To recap, an IPO is a company's transition from private to public, a major step to raise capital and enhance its profile. The process involves underwriters, a detailed SEC filing called the S1 Roadshow to attract big investors, and finally, the pricing and trading of the stock. For investors, IPOs present both exciting opportunities for growth and significant risks due to volatility and hype. Think of Airbnb's massive pop, but also remember that many IPOs don't perform as well. The most important takeaway is to do your homework. Don't invest based on headlines alone. Dig into the company's fundamentals, understand the risks, and make an informed decision. Investing in an IPO can be rewarding, but it's a marathon, not a sprint. Thanks so much for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more content that breaks down the world of finance. And let us know in the comments if there are any other topics you'd like us to cover. See you next time.